And for the next session, avoid pitfalls in post-rollout ESOP valuations, how CFOs can mitigate them. For this, I would like to introduce Ms. Neha Prasad, Associate Partner Consulting Qapita. Ms. Neha Prasad is a chartered accountant with more than 10 years of experience in management consulting advisory of equity-based compensation plans, options, accounting, legal drafting, and business valuations, presentations and interactions with CXOs, CEOs, and board of directors for various prestigious entities, managing team, consulting, and valuation team. Can we have a huge round of applause for Ms. Neha Prasad?
Okay, thanks Mitali for that introduction. Absolute privilege to be here presenting some of my insights from my experience to the industry veterans, some of our esteemed clients who are here amongst the delegates, some of my batchmates are here. And every time I'm in Delhi, it feels nostalgic because I was here for some time prepping for CA. Some wonderful memories associated with Delhi, and I feel bad as soon as you land Delhi, there are memes about the bad air quality, right? So people are completely forgetting the fact that the warm and the wholehearted welcome that you get in Delhi from Delhiites. So can we have a round of applause for the spirit of Delhi? Thank you. Thank you. So with all the attention from everyone and on the positive note, I'll start. So the agenda, as you can see, I'll be decoding the ESOP valuation, simplifying some of the jargons for you. I'll be sharing some of the best practices on how to manage the cost, the taxes, and how to mitigate some of the regulatory lapses that might happen through valuations. So see, valuation is just not a number, right? It is a tool to set the stage for the success of your ESOP plan. So we'll go through it. So before that, one simple question: how many of you like surprises? Show of hands. Okay, but if I add that not all surprises are good. So if I add that these surprises are just before the board meeting, and you get to know that you need a valuation report without which you can't do the grant of options, then will your answer change? Right? So no one likes to be in that situation when there is a last moment hustle, there are situations I think all of us can relate to because all of us are from finance. At times there are auditors, they are not willing to sign on your financials because they feel that the valuation report is not proper, the assumptions taken are not proper probably, and at times you get to know just because you have modified certain terms in your ESOP plan, there is unanticipated cost to your P&L. So I'll like to prepare you and inform you so that you avoid these last moment surprises. So let's start with the very basic of ESOP valuation, and we will break it down into two basic components. One is FMV and FP. These are two generally oftenly misinterpreted terms. While FMV refers to equity valuation, the FP refers to stock option valuation, and the difference between the two is as basic as that of equity and stock options. Now for equity shares, why do we need a valuation at all? So since the stocks for the unlisted entities, it is not traded on any stock exchange, the prices are not discovered by the forces of demand and supply, we need an independent valuer to do the valuation and tell us about the value of the company. Now the valuer may choose any of these methods, right? He can choose any of these methods like cash flow, market multiples, or NAV on the basis of certain factors. He might consider, what is the industry like? If it's a banking industry, it's a manufacturing industry, or it's an insurance company, or like for revenue multiples, whether the peer related data is available in the public domain or not. What is the growth trajectory of the company? It's an early stage startup, or it's a matured stage company just headed for an IPO, right? Or if there has been any capital infusion in the recent past, he will consider all these factors and then he will decide on any of these methods and give you a valuation report. So getting a fair market value report, it is the first step towards valuing the stock of the company, because stocks are derivatives of underlying equity shares. So we need a fair value certificate to get the fair value of the stocks. Now why do we need fair value of stocks? Fair value of stock is required because there is a regulatory requirement by Ind AS 102, which is on the share based payments. It says that you have to recognize the cost for any equity compensation plan based on fair value of options. In addition to Ind AS 102, if you are a banking company or an insurance company in India, then even the quantum of the options to be granted to MRTs or some of the key employees, that is dependent on fair value. So just before NRC, you need a fair value report in order to decide on the number of options to be granted to your MRTs or key employees. Now for determining fair value, so these are some of the models well known and accepted: Black-Scholes, Monte Carlo, binomial. While Black-Scholes is the most widely used kind of model because it's user friendly. It works on plug and play kind of a model it is, where you input the values and then you can you get the fair value based on the intrinsic value of the options, and it also considers time value of money, the risk factors. The other two models are slightly more complex. It works on probability and simulations. For unlisted companies, for getting a fair market value report, discounted cash flow method is the most widely used and accepted method, right? So once we have discussed on the models, it is also important to understand what are these key variables which has a bearing on the fair value of the companies. Why is it important to understand this? Because next time you are granting options, or if you are planning a scheme, you can be mindful of these factors, because this can significantly impact your cost, right? Fair value is nothing but the cost per option. So if you look at these 6 parameters, if we increase all these parameters, which goes into a typical option pricing model, then we see that there are 4 parameters which has a positive correlation towards fair value. So these are market price, and then risk-free rate, expected option life, and volatility, out of which volatility is the most important. It will impact your fair values the most. If we look at the other 2 parameters, that is exercise price and current dividend yield, it will decrease your fair value. So that means if you have to manage your fair value or cost per option, then you have to maximize on these 4 parameters and need to minimize on these 2 parameters. Now let's have a look at some of the strategies to manage your cost and to avoid those situations what I was talking about. So the very first one is FMV. FMV is the first factor that goes into option pricing model, and for listed entities, the companies, if they see that the prices are at discount, it is trading at discount, it is slightly undervalued, and if you are granting your options around that time, it will definitely lower down your cost, right? As far as volatility is concerned, see, for listed entities, we do not have that flexibility to adopt anything apart from the historical prices, its own prices for volatility. But for unlisted companies, we have lot of flexibility here. What we can do is that we can consider a listed peer entity for volatility. We can also consider a combination of peer entities, like taking 4 or 5 peers and then assigning a weight to it. What we can also do is that if there is no comparable peer, we go for index volatility as an industry specific index like Nifty for financial services, But then I'll be upfront with you, or the auditors, especially Big Fours, they are not approving of the index volatility. They feel it lowers down your cost. Now frequency, what is the frequency of these fair valuation report? If it's an equity settled plan, you need it just once in the lifetime of a ESOP, and then the cost is established. But if it's a cash settled plan, you need to market to market, right? So every time at every reporting date, you would need a fresh fair valuation for a cash settled plan. What I would like to highlight here is that if at all your vesting conditions, they are linked to market. By market linked condition, I mean to say that if your vesting is associated with certain target price, let's say there is a target price of certain amount, the share price is reaching certain target amount, or for unlisted companies, it is the vesting itself is associated to ROI or the exit value of investors, then Black-Scholes doesn't work here. We have to go for Monte Carlo simulation, which is a cost intensive method and it takes time. So be mindful of the vesting conditions while we are drafting ESOP plan. Then there are these two adjustments. If at all any corporate action happens, then there is a concept of giving appropriate adjustment to the options, right? A fair and reasonable adjustment needs to be done. So for fair and reasonable adjustment, what we need to do is that we need to do a fair value pre and post corporate action, whatever is the date of corporate action. And if we find any impairment in the value of options, then either we need to adjust the exercise price, lower it down, or probably we will have to grant more number of options. Similarly, for modification, if you do any modification in terms of the scheme, let's say you are reducing the exercise price, you are extending the exercise period, then again there is a requirement of pre and post fair valuation for all the outstanding options as on that date of modification. Now there are two other parameters which can impact your fair value, that is time to maturity and dividend yield. For time to maturity, either we can take the average time from the date of grant till the date of vesting, or there is another concept of exercise behavior. You can analyze the HR data and see historically how these exercises have been done in the past and apply that to option pricing. Now let's have a look at the timeline. When this will give you an idea about when what valuation is required, under which authority, and during what what stage of ESOP life cycle these valuations are required. So as you can see, this is the typical life cycle of any ESOP equity based plan. It starts with NRC. So very first thing, if you are a banking company or an insurance company, you need to establish a fair value, get a fair value report for establishing the number of shares. Between the grant date and the vesting date, you get a registered valuer certificate to establish FMV of the company. If at all you are granting to US employees and you have included US subsidiaries, then you need to get a 409A valuation report, because there is a section in US IRS code which says that 409, the option should not be granted below FMV. So there is a requirement of 409A valuation. Then the other valuation which will be required to establish your cost, what I spoke about right now, that is FV under Ind AS just before the reporting date. When the options are exercised, then you would need a merchant banker valuation to establish how much of a cost is to be paid, right? How much of taxes has to be paid, and to establish the perquisite value in the hands of employees. And lastly, when you are selling the shares, you would need a merchant banker certificate either under FEMA or IT Act if you want to comply with 11 UA. Now at Qapita, our mantra and our belief is that we help all the stakeholders in unlocking the power of ownership. So what I feel is that in order to share that wealth, the wealth has been created in the hands of, in the company, then it has to, like, first step towards it starts with the valuation which is authentic, which is accepted by all the authorities. It is accepted by the investors, shareholders, the employees, right? So this is about my organization, where we are providing all the services for ESOPs and equity. It starts with consulting and advisory services to curate a plan for you, and then provide all the necessary support to manage that, and also support you with accounting, financial reporting, valuations, legal documents, and then finally a marketplace to plan your liquidity, and also ESOP funding. Yeah, the slides are not moving. Yeah, so these are some of our marquee clients, and I need that slide. So we have a booth here. If you want, you can visit us for some more details. And also we have this survey going on. Every 2 years we come up with a survey on equity compensation trends. Last time we did in 2022. Currently we are running for 2024. If you can scan that, sorry, the slides are not working, it's okay. So if you can scan that QR code and participate in that, you will be getting a copy of that report as soon as that is published. Yeah, I think some of our clients are also here with us today. So I'm sorry, I think IDFC is also our client, it's not mentioned here. So thank you. I'll be here. I think we don't have time, right, for question and answers. Okay, so I'm here. You can visit us for any questions if you have. Thank you for being patient.
Thank you so much, Ms. Neha. And to do the felicitation, I would request Mr. Aditya Chamaria from Grupo Bimbo to do the honor.